afternoon, everybody. My name is Cami Daigle, and I'm going to be giving a presentation today on analyzing a company based on its financial ratios and its risk measures. So this is for our finance class 695 for the summer of 2013 executive MBA program. Okay, so the company that I chose to analyze today is 3M. 3M has a lot of really good reasons to invest in. First of all, it's highly diversified. You can see here on the screen there's tons of different markets that 3M participates in. Consumer products, you know, of course, Post-it notes and Scotch tape. Also electronics and energy, healthcare items, industrial applications, and then safety and graphics. Why did I choose 3M? Well, first of all, it's a Fortune 500 company. It's a part of the Dow 30 index. It's also a part of the S&P 500 index. So it's definitely looked upon highly as a member of the stock exchange, and it's a really great company, in my opinion. So a few of the reasons why I chose it particularly was its return on equity. It has a relatively low beta, which is a personal preference of mine because I'm not much of a risk taker, but that's just personal. The stocks pay dividends. They are a highly diversified company. They have their hands in a lot of baskets, and they seem to be pretty good at all of those things. Proven longevity. They've been around since 1902. They started as a mining company and just have kind of, I guess, been innovative since and kind of switched up what they've done and make sure that everything they do they're good at, or they'll liquidate the company if it's not going so well. Also, there's a pretty high return, or at least a decent return on most people's investment, and then they have a really good price to earnings ratio, which is important to me as a stockholder because it tells me what the market thinks about the company, for their future behavior. So the first thing I want to talk about is the liquidity ratios that go along with this company. The first thing is the current ratio, which we know is the current assets divided by current liabilities. So the current ratio is 2.33. That tells me that 3M has plenty more than enough in assets to cover its current liabilities, which are its liabilities for the next 12 months. The second ratio is the quick ratio, which is the current assets less the inventories, and that is all divided by the current liabilities. So the quick ratio is 1.48. That tells me that 3M has more than enough in cash and accounts receivable to cover its current liabilities for the next 12 months. And lastly is the cash ratio, and I'm actually really happy with this one. It's 0.74, and that tells me 3M has enough cash on hand right now to cover very close to 75% of its liabilities, if necessary, if something were to happen. So that's a pretty impressive amount of cash. I think it's somewhere around $4 billion, so it's pretty high. Next, we'll talk a little bit about the profitability ratios, which we're all very familiar with. The profit margin is the net income divided by total sales. So that ends up being about 14.86%. The second one is going to be the return on assets, and that's our net income divided by our total assets, which ends up being 13.57%, which I'm happy with as well. And lastly, the return on equity, which we all know is a very important number for us when we're analyzing companies and judging their performance. That's going to be the net income divided by the total equity, which in this case for 3M is 25.48%, and I'm very happy with that as an investor. So this is making me feel really good, these numbers here, and that's a big way of deciding whether or not I feel okay investing my own money in this company. So let's talk a little bit more about the return on equity and go a little bit more in depth. In our last class, we talked a lot about the DuPont analysis and basically how to figure out what is driving our return on equity. So here we have the return on equity equals the EBIT margin times the interest burden times the tax burden times the total asset turnover times the equity multiplier. So I pulled all of those numbers from Bloomberg. I finished the equation, which ends up being the 25.48% that we talked about in the last slide. And you can tell that this is a high return on equity, but it's driven by a high total asset turnover, which tells me that the company really uses the assets they have on hand to increase their revenue and in turn increase their net income. Also, it's driven by a somewhat high equity multiplier. You're looking at the assets at 1.87, the equity at 1. I don't know the exact numbers, but this works just as well for the ratio portion of it. And this tells us that around 47% of the amount of assets that 3M holds are financed by leverage. So that's not too much in my opinion, and it's clear with their cash ratio and their liquidity ratios that they can handle the amount of leverage they have as of right now. So basically, to figure out the 47%, I took 0.87 divided by 1.87, and that told me a little bit about the leverage that we have going on with 3M. So that amount of leverage is acceptable to me as a stakeholder or shareholder, and that's just a personal preference, so I'm okay with that. And clearly in this case, considering that this is a very successful company who doesn't have a problem with making money and keeping a good deal of it as net income, retained earnings, and then paying out dividends, clearly 3M uses leverage to magnify their gains instead of magnifying their losses, so I'm okay with it. So next we're going to talk about the beta, which is a measure of risk when adding a security to an already diversified portfolio. So a little bit about the beta equation and how we come up with this number is we're going to end up with the beta of our investment, which equals the correlation coefficient between our investment and the market times the standard deviation of our investment divided by the standard deviation of the market. So I have everything listed out here in case you didn't catch any of it, but moving a little quickly. But the coefficient, or the correlation coefficient, also equals the square root of R squared, which is something that we found in Bloomberg to help us figure out this equation a little bit better. And then the standard deviation of the investment over the standard deviation of the market is going to end up being our relative volatility, which we'll get into very shortly. So I grabbed this screenshot from Bloomberg, and I picked up the raw beta here at 0.962, and then I picked up the R squared, which is the correlation squared, at 0.75. And then we also have the correlation at 0.866. So we're going to take those numbers moving into the next slide, and we're going to plug them into the beta equation. So we have the beta equals, again, correlation coefficient times the relative volatility. And we're going to back the relative volatility out of this equation because we're given the beta and the correlation coefficient. So we end up with 0.962 equals the square root of 0.75 times the relative volatility. And we just go through the motions with typical algebra, and we end up with relative volatility of 1.11. So basically over here to the side, we're looking at what some of these variables mean. So the beta is telling us that 0.962 means 3M is slightly less volatile than the rest of the market. Our correlation coefficient is telling us that 0.866, that means that 3M moves pretty similarly with the rest of the market when they have its ups and downs. So if the market is really high, you're looking at 3M being high also, but not quite as much. And if it's really low, you're looking at 3M also being low, but again, not quite as much. So then lastly, we look at our relative volatility, which means as 1.1, it means that the standard deviation of 3M is slightly higher than that of the market. So basically, we've got a couple of pieces of information here that may not make sense necessarily looking at them right now, because the beta says it's less risky, relative volatility says it's more risky than the market. So let's get into that a little bit closer. As far as the relative volatility goes, how can we have a relative volatility higher than 1, but somehow end up with a beta less than 1? That's kind of confusing for some. So basically, the RV of 1.11 tells us that 3M is riskier than the market, and the beta of 0.962 tells us 3M is less risky than the market. So the way it works out is that we can end up with a beta that means 3M is less risky, because 3M does not correlate exactly or identically with the market. So basically, therefore, even though we have an RV that's higher than 1, since 3M doesn't correlate exactly with the market, it's not as risky to invest in 3M when you're adding it to an already diversified portfolio, which is what the beta is telling us. So that's how that works out. Next, we'll talk a little bit, briefly about the economic value added. It's a measure of a company's financial performance based on the residual wealth, and it's calculated by deducting the cost of capital from the operating profit. So basically, you're taking your net income and then you're paying off your cost of capital, and your economic value added is what you're actually keeping past everything that you've paid for. So again, we have a screenshot from Bloomberg here, and it's giving us some of the numbers that we're going to use in the next slide to calculate the EVA and the EVA spread, which is just a percentage. So the EVA calculation, you can see here, it is the NOPAT, which is the net operating profit after taxes, and we're deducting the capital charge from that. So we just pulled these numbers straight from Bloomberg. We end up with an economic value added, and I think this is in thousands, of 2410.35, which I'm happy with because it's positive. We're making money, we have a net profit, we have retained earnings, and we have money to pay out to our shareholders in dividends. And then if we look at the EVA spread, which basically just puts this into a percentage, you're talking about the weighted average cost of capital minus the return on invested capital. And that ends up being 8.67, which I'm happy with as well. So now we'll talk a little bit about the stock price, what the company is worth to me as a shareholder, and what it could be worth in the future. So what I did was I pulled the fiscal year 2008 through 2012. I pulled from Bloomberg the earnings per share, the price to earnings ratio, and then I just multiplied the two of them so that the earnings ended up canceling out, and I was left with the price per share. So you can see here that I did all the math here for what I know for sure 2008 through 2012 that's already been reported to the SEC. As far as the fiscal year ending 2013, we don't know because we're not there yet, so this is going to be an estimated amount. And then for 2014 also, it's going to be an estimated amount as well because we're not there yet either. So as of right now, the stock price for 3M is about $107 to $108. So by the end of 2013, we're looking at an estimated $113.97, 114 for the fun of it, I guess. And then for 2014, we're looking at about $108 to $109. So we are going to see a little spike by the end of this year, and then we're going to see a little bit of a loss in 2014. But, as an investor, I understand at times I'm not happy to lose money, but at times it will happen. So, either way, it may just be an opportunity to purchase a little bit more, or, have somebody else that I care about maybe want to purchase a stock price at a lower price than it has been. So we'll talk a little bit about the dividend discount model here. Basically, this looks a little jumbled up, but what I did was I grabbed fiscal year 2008 through fiscal year 2012, the dividends that were paid out, and then also for February and May of 2013 because the dividends are paid quarterly. So basically, you can see it's been 50 cents, 51 cents, 53, 55, 59, and now we're up to 64. So this is just historical data that I pulled from Bloomberg. As far as the dividend discount model goes, what I did was calculated the growth rates between 08 and 09, 09, 010, 10, 11, and so on and so forth, as you can see here. And then I calculated an average growth rate for all 5 years. So you're looking at adding up the growth rates, dividing them by 5, and we end up with a 5.09% growth rate. So the next thing that I did was I took my average growth rate that we just calculated, and I chose a required rate of return, which is a number that I chose, not necessarily arbitrarily, but for the fun of it, I chose 5.5%. So I took my expected future dividends, which is 0.64, because that's what we're dealing with right now this year in dividends, and then I multiplied it by the average growth rate, and I ended up with 67 cents. So in order to get the present value of expected future dividends, I took my expected future dividend, which was 0.67, and then I divided it by my required rate of return minus my average growth rate, and I ended up with $163.42. So using that required rate of return that I used, I ended up with $163.42, whereas the current stock price is $107.56. So looking at it in this particular example, the stock is currently undervalued, and that makes me a happy investor, because that means I have stock that's worth more than what everybody else thinks it's worth, or worth more than I would pay for it right now. So it makes me a happy camper. A little bit about 3M in the news right now, or I guess a little bit in the past. All of these things are telling us that 3M has been pretty steady, and they've grown actually. So starting with the least recent, I guess the most distant past, in 2006, 3M liquidated a drug business that they had going on, and it wasn't doing quite as well as they had wanted it to, or they wanted to back out of it, and they ended up liquidating it for $2 billion. That really helped out with their, cash they had on hand, and they were able to get rid of something they weren't comfortable with keeping. So that was a smart move. In 2010, 3M reported 42% rise in profit in Asia, which is huge. That's a huge rise in profit. Later in 2010, in August, 3M acquired a company called People Tracker, which basically does just what it sounds like. If a adopted child is looking for their birth parents, they would use a company like this to locate someone they were trying to get in contact with. Even later in 2010, 3M gains 52% of Cogent stock, and Cogent is a really interesting company. They do biometrics identification, such as fingerprinting and facial recognition software and that kind of thing. So that's a little bit different from Post-it notes, but 3M's still a big part of this, and they own over half of the company, so it's a huge thing for them. And then lastly, 3M rethinks the design of Post-it notes and Scotch tape, which sounds small, but when you think about it, this is their way of being innovative and not just staying stagnant. And they're moving according to the market and what people are wanting. So, every now and then we don't, some of us like to stick with the same old thing and we don't like change, but most of us are excited by it and we like innovation. So all of these things here from the news in the last few years tell me that 3M really keeps up with the times, and it tells me that they're really trying to diversify and basically figure out what they're good at and stick with what they're good at. So they'll liquidate a company they're not comfortable with, and then they'll acquire other companies that they are comfortable with. They've always been really good with research and development and that sort of thing. So it tells me that they really know what they're doing, and they take enough risk for it to be rewarding to them, but not so much to where it becomes, I guess, not good for the company. So that's a little bit about 3M, and hopefully you guys have learned why I think it's an interesting company and why I feel like it's a company that I would be comfortable investing my money in. So I would appreciate if you have any questions or anything to let me know, and we can discuss a little bit further. Thank you.